Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, March 24th, 2017. So we'll look at stocks today, which I think are not yet done correcting, but I still think they're firmly bullish. And I think we'll get to fresh highs sooner rather than later. There is a little bit of a fear that is creeping into the markets, and this is showing in bonds which are rallying despite uh, the rise in interest rates. So also US dollar is losing ground versus other currencies, but I don't think it's bearish just yet. And gold is taking advantage of the weaker dollar, and um, now it's kind of moving higher again. Oil still continues lower, and I don't think the bottom is found. And then finally, we'll look at natural gas, which is again moving higher. All right, let's look at our proxy for the market, ETF SPY, S&P 500. So just here in March, we had all-time highs, and I thought that this was an exhaustion gap, but I had a question mark here. Now I removed the question mark. This is definitely an exhaustion gap. Looks like we had a initiation gap here, a beginning gap, and then an exhaustion gap. Now looks like we're trying to work off some of the overbought conditions, and they're moving lower. Initially, I thought that this was it, and I thought that we're going to find support here at 234 for SPY. It did not happen. Looks like we have a couple more red candlesticks. I have a feeling we may need to correct some more. I don't know to where, and I don't think anybody does. It could be 3%, 5%, or we could just trade sideways. So it could be a correction through time or a correction through price. So market breadth, I don't see any major issues. We hit all-time highs on the advanced decline lines together with the all-time highs on the actual index. So now we have a normal pullback. Again, here's one level to watch here at the 50-day moving average. The breakout level, I would say, is around 226. We have breakout here above previous consolidation. So anything here would be a good place to bottom, and I don't see that pattern just yet. At MasterChartsTrading.com, I will send an alert to my subscribers when that pattern becomes evident. Here's a longer perspective for the same S&P 500. My market breadth index is firmly bullish, high readings, excellent breadth. So again, I don't see major issues long term. Here's RSI on the S&P 500 in the daily time frame. It was overbought, it became a little more overbought, and then finally we worked off some of these conditions, so now we're no longer overbought. But in a bullish security, overbought means pretty much nothing, because bullish securities become overbought normally. Long term, S&P 500 is bullish because I think market breadth is bullish. Here's percentage of stocks above 200-day exponential moving average. It's firmly in the bullish territory with no major divergences. Bullish percent index is doing the same thing. If we drop on these two readings to, let's say, I don't know, 30s or 40s, I would become quite worried, but we are not there yet, so let's not worry about that. S&P 500 on the weekly time frame, we came exactly to the pivot point and touched, well, almost within a few points of it right there. We almost touched it and pulled back. Again, maybe we'll pull back to the breakout levels, which in this case are about 2286. Or we could bottom anywhere in between, or we could pull back even more, but I wouldn't even worry about the pullback until we get, let's say, to like Brexit lows from last June here. So that's still quite a lot of room to fall should we even get there. Normal corrections are about 3 to 5 to 7%, so anywhere around here would be a good place to bottom. Dow Jones Industrial Average seems to be even weaker than the S&P 500. Notice that there was a bunch of red candles and there was no white candle here on Wednesday. But as far as the advanced decline lines, it's still firmly bullish, so I wouldn't even worry about it just yet. Here's QQQ, and this is extremely strong, all-time highs, and the pullback is really small. So again, not even sure if it's could be called a pullback. Here's QQQ. On the longer term time frame, the same thing. No major divergences just yet. So no major divergences on QQQ still. Here's a percentage of stocks above the 200-day moving average and bullish percent index. We pulled back from very high levels, so we got 84 and 89 here. We're pulling back together with the actual index. So that's kind of like a normal pullback. I don't see a major issue here just yet. I mean, if in the future we get something like a higher high, but a lower high here on the bullish percent index, maybe that will signal a slowing or a narrower participation, but right now it's just not there. So what I do see here is I see a normal pullback, a very shallow pullback, and think eventually the bottom will be found and we'll probably make fresh highs. So IWM was kind of like a weaker part of the market. The small caps, they were underperforming here. Additionally, there were divergences here, so we could see fresh highs. But there were no fresh highs made in the advanced decline lines. You can see advanced decline line made a high here in December, and the advanced decline line here made it in January. The index continued higher into March to make fresh all-time highs, but the breadth did not confirm it, and looks like we're finally getting a pullback, and looks like we are making a lower low here. So you can see that a low from January is higher than the low from March. So I thought here we're going to already move higher, but this doesn't feel like a very strong push higher. I think we will need to come down a little more, maybe at the list, maybe like retest this low at 129 from December lows. Here are the divergences that I was referring to. You can clearly see IWM making a higher high. Momentum divergence. Not a big fan of momentum divergences, but they do occasionally work out. You can even see on the shorter term indicators, this is a percentage of stocks above the 20-day moving average and the 50-day exponential moving average. You can clearly see a divergence here. More worrying to me was the fact that percentage of stocks above the 200-day was dropping while the index was moving higher. So this is a clear divergence. So it seems to be working out. Whether or not we will get a strong pullback or a mild pullback is anybody's guess. But again, I do see decent support here around December lows. And then we can see a possible pullback as far as, highs from September, October of last year. So that would put IWM somewhere in the vicinity of 125, 126. Obviously hasn't happened yet. It's also very much possible it will find support here and just continue higher. Finally, the broadest of them all, New York Stock Exchange Composite Index, made an all-time high here in beginning of March and pulled back. So right now it's still an orderly pullback. Advanced decline lines are confirming just a normal pullback, and I don't see any divergences or a major issue here as well. As far as percentage of stocks above 200, it's not that bad. It's like around 66, and bullish percent index is around 65. So again, I would start worrying if we somehow drop to like maybe 30s, then I would start worrying a little bit. So to summarize, S&P 500 most likely will pull back some more. I don't think we're done correcting, but this is clearly still a bullish chart, so I think stocks will make fresh highs sooner rather than later. Here are the bonds. This is first, let's look at junk bonds, JNK. High correlation to the general market. You can see the correlation coefficient spends most of its time in the positive territory. So these are pretty much, in my opinion, an extension of the stock market. So these are all-time highs, and this is a adjusted graph. In other words, the dividends are, or the prices are adjusted for dividends. So all-time highs here for JNK, normal pullback, attempting to bottom, big surge here, another pullback, another attempt at the bottom. So right now there seems to be at least some support around here at 36.19, 36.20. Whether or not it will hold, it will depend on the general stock market. So if the stock market pulls back, I think we can expect a further pullback in JNK. And I see, I guess, a support level here at around 35.57, which is December lows, and additionally the 200-day moving average is around that area as well. So a good place for it to attempt to bottom would be around there. Here's JNK on the longer term time frame, weekly time frame. Again, correlation is high between the general market and JNK. Occasionally there are negative correlation, but by and large it's positive. So I would lump JNK together with the stock market more than the bond market. So again, all-time highs here in the weekly chart. Now we have a pullback. Nothing that I see terribly worrying just yet. No volume spikes. You can see like a big volume spike here near the bottom. So potentially this could have been like a bottoming sign. But I don't see the same thing around current, so it's not a very large volume spike. It's just somewhat of a large volume spike. Yeah, so again, JNK, I think eventually will, in my opinion, this is a bullish chart, and I think we'll find bottom and rally from here. The surprise came with the investment grade bonds. During the last week, I explained what happened there during the Janet Yellen speech when interest rates were announced that they're going to be going up. Bonds should have dropped, but they didn't, and this is what happened. This is the big candlestick here, and they rallied from there. So this could be a bear trap. This is LQD, by the way, investment grade corporate bonds ETF. So this could possibly be a bear trap, and we could be rallying further. There is still this semi-unfilled gap. From November, we attempted to fill it here. In February, we failed and pulled back. So again, this area seems to be as far down as bonds will drop, and that's the reason. There is, when people are buying bonds, that means that there is more of a fearful posture in the markets, and since stocks are pulling back, a logical choice for investors would be to rotate at least some of the money into investment grade bonds. So this is a longer term chart of LQD. This is a weekly chart. Again, I cannot make a case that this is a bearish chart. These are all-time highs in August of last year. This is a breakout from 2016 April. So what I see here is we came down exactly to the breakout level. The breakout occurred above April 2015 level. In April of 2016, we came back to exactly that same level, basically retested that and successfully rallied. This is another throwback right here, and now another rally. So now we have 2 weeks of continued gains for bonds. So I still can make a case that this is a bullish chart, and we could still continue higher from here and take out these highs. Again, this would mean that there is more fear in the markets, and honestly, the stocks are in need of a decent pullback. So a rotation into a LQD would make perfect sense. Here's TLT, the 20 plus year Treasury bond fund, the longer term Treasury ETF. This is as safe as it gets, and investors normally rotate into treasuries during the times of crisis. So big drop here in November. We continued lower, and these are 52-week lows here. And that's what threw me off, basically, is that TLT is kind of, hitting 52-week lows, but for LQD, these are not 52-week lows. So that's what kind of threw me off, and I really had a really hard time deciding whether I want to be selling this chart or want to be buying this chart. But it seems that we have bottomed out for TLT, and we came down to about that same 52-week lows. By the way, again, this is an adjusted chart. In other words, it is adjusted for dividends. And looks like we bottomed out here and rallied. Now we are coming to this area of previous peaks. Maybe the fourth time is the charm. Maybe we'll break out and finally fill this gap from November. It looks much better on the weekly chart. This is a support I was referring to just now from December lows and now from March lows. So it looks like we have bottomed out here, and I think the support have held so far. So I think we could easily continue higher above 2017 highs here from January, and again maybe we'll close the gap finally around from November gap. And together with the fact that stocks are a little bit showing a little bit of a corrective period, I think it would make sense that defensive posture is more manifest as we speak. Moving on to the Forex universe. This is US dollar in the daily time frame. So big surprise came when Janet Yellen announced that the interest rates were going up, yet the dollar reacted in a completely unexpected way and actually dropped. So we kind of continued dropping since then, and we are kind of coming to the previous lows here from December, February, and March. Whether we will break them is anybody's guess. It is entirely possible that we'll break them and continue lower. I think this is still a bullish chart, especially if we look on the weekly charts. This is a weekly chart of the US dollar. So back in 2014, 2015, we had a big move up, then we had a sideways consolidation, and finally a breakout here in November of last year. These are multi-year highs here in 2017, and now we're sort of pulling back from those multi-year highs. And I think that even if we come down significantly lower, I think I would not start terribly worrying about whether or not we had a reversal, probably until we get to 2016 lows. So again, I mean, this to me this chart still looks bullish. If we do break these levels here, I think we may pull back, like I said, to maybe like November lows here. Um, anything can happen, but I still think that maybe we'll do like a little bit of a sideways and then finally break out the upside. But it is also possible that we're not going to do it, and maybe we have indeed witnessed a reversal. With Janet Yellen's speech just recently. Time will tell. For now, this looks possibly like a double bottom, or maybe this is a cup, and now we're forming a handle. And if we get a breakout here, we can continue significantly higher. Euro versus US dollar. Now this is where the interesting action is happening. So euro, versus US dollar is coming up to the test of previous support break, which occurred right there in November. We broke below October lows, rallied. We got resistance exactly there, dropped to multi-year lows, pulled back again that same area, and then again dropped. But then, around here, beginning of March, we started to rally, and now we are coming up to this exact same area. So here, multiple things are happening again. Lots of action around that area. We've got 1, 2, 3, 4, and now 5 touches, and also the 200-day moving average. So there are multiple things happening in this area. If we break out above this area, of course, dollar will come under severe pressure because DXY, the US dollar index, is, I believe, like 50% euro. So euro is coming up on an important test, and here's that same chart of euro versus US dollar on the weekly time frame, and here's that upcoming resistance, which is at around 1090, I guess, 1085, 1090. So there it is, and we'll see if we move above it. If we do move above it, then it's possible we may be reversing in euro. Maybe, because this is multi-year bear market for euro. Who knows? Maybe we have bottomed out here. US dollar versus Japanese yen, the opposite is happening here because it's traded the oppositely, US dollar versus Japanese yen. So I thought that we have finally bottomed here, but no, looks like we broke below it here just this week, and then continued lower on Thursday, Friday, Wednesday, Thursday, and Friday. It's a little bit more obvious on weekly charts, so let's just go there. So I thought that we had a bullish engulfing on the weekly time frame right here, and it was confirmed. Clearly that did not work out, and we reversed with 2 bearish candles previous week and this week, and these are actually again lows for the move. So what I see here is a corrective pattern, possibly in a way of a fallen flag. I think that if we get a breakout with a close, say, above 115.50, I think that would be quite bullish, and we could continue significantly higher. But maybe the corrective pattern has not yet played out. So again, if the US dollar versus Japanese yen continues to drop, then DXY, the US dollar index, will also continue to drop. And when we get to the gold, it will actually help gold tremendously. It's been helping gold quite a bit. Okay, here's GLD, gold on a daily time frame. So here's what's been happening as of late. So we got the rejection here at the 200-day moving average in February and pulled back quite sharply. This was very sharp pullback into March, bottomed out and then surged. And this is the surge I was referring to when we had a surprise move in the US dollar. Despite interest rates going up, and then US dollar dropped, gold took a very good advantage of it and rallied from here. Now this line I did not redraw it, it was here before and looks like we're coming against it, exactly against it. This line is a previous breakdown level, so that's where I drew it. I drew it from the close right there, and then we had a breakdown here in November, and we came up around that area in February. So there is resistance here, and this resistance is marked by the 200-day moving average and previous support break. So we're still kind of working in this area trying to break above this resistance, and so far we're still having quite a bit of trouble. Here's the weekly time frame, and this one looks a little better actually than just a few weeks ago. So here a few weeks ago we had what I thought was a bearish engulfing on a weekly time frame. So looks like this candle was completely engulfed by this red candle, and the important thing is the next week we got follow through to the downside. But then the previous week we had a hollow candle which was inside the previous week's candle. So this was an inside wick. And now we have an inside wick with a confirmed breakout above it this week. So this is an inside wick with a breakout above it. This looks very good actually for gold, honestly. So maybe finally we will be able to break above this resistance area at around for GLD around 120 or so and continue higher. Now there is more resistance up here at the previous broken support at around 124 and change. So more resistance of course up there, but if we do break above it, then we are going to be very close to 52-week highs, and that would improve the general posture on gold. In fact, let's look at GDX. So GDX, Gold Miners ETF, this is a daily time frame. So we had a from here, from December lows, we had a big rally. This is about 30% move or so, which came to exactly previous resistance levels. I actually pointed them out repeatedly. If you listen to my videos, these were the rejection or the resistance levels, and they were, the bears took advantage of them, pushed the prices really hard down, into March. Then we had bottom in action here, and finally a surge. So this surge is again had to do with the dollar. Dollar was unexpectedly moving lower, and this is looking much better because it seems like we're making a higher low, and this is now. It used to be like we're making lower lows into August, September, November, December, and now here we're making a higher low relative to the December low. So this is looking much better now. So this chart is definitely improving. Also, market breadth is not showing any major bearish divergences, because you can clearly see that March lows for the advanced decline lines and advanced decline volume lines is lower than is higher than the corresponding levels from December. So this is good news. And additionally, the bullish percent index is also moving higher. So again, this is definitely improving. Should the dollar decide to turn around and rally from here, of course this will all change. But for now, this chart is improving. Here's my same thing, GDX, but it has some of my proprietary market breadth indexes for gold. Here's gold breadth index. It is still in a bull market. You know, it hasn't really dropped into bear market, so it is still weekly bullish here. Some of the inputs here are percentage of stocks on a buy signal. The bullish trigger here is 90, and we have not been able to get there. We really tried here in November, here in January and February. We really tried to get above 90, and we just couldn't. Even with this really big surge, we couldn't get above 90. So right now we're at 62 and a half. We were at 75. So we're again attempting to go higher, but we haven't, haven't gotten there yet. The bad part is that one of the inputs actually got worse. So we were at 50% here just a couple of weeks, just last week actually, and now we dropped to 37.5. So one of the inputs actually got worse. But as long as the dollar basically continues sideways or maybe slightly down, I think this numbers will improve, and I think we could actually get significant improvement. Maybe we will even get improvement in the overall gold breadth index, and maybe we'll move higher from here. So finally, here is weekly GDX. Looks like this level played out from May of 2016, right there in February and March, and we didn't drop below it. So who knows? These two candles, weekly candles, are not terribly bullish, because look at this selling tails out of the top here. But maybe we'll move higher. Who knows? I mean, we are again, I'm saying that we are making a higher low relative to December low. So it is looking better for bulls, for gold bulls than before. Right, let's move on to hard commodities. This is West Texas Intermediate, light crude oil. This is a daily time frame. So if you listen to my videos, I was pretty consistent that I still think oil is in a long-term bear market. Even though these are 52-week highs back here in 2017, especially this big red candlestick with rejection tail out the top and big red body and a close near the low of the day. The close was near the low of the day. So this was very bearish candle, and I thought that this was it basically, and indeed this was it. But it took a really long time. It took like almost 3 months to finally break down, and this breakdown was significant. It looks like we had a big red candlestick, follow through lower, slight rebound, and then another follow through lower. So it looks like we're making yet another lower low here and continuing lower. We could bounce back to the broken support levels, but I still think the direction is down. And if we look on the weekly charts, there's like plenty of room to fall basically, but I just don't see it really going higher from here. Anything is possible in the stock market, but I think that the direction is down here. So this is again that consolidation I was referring to. 3 months worth of consolidation, finally a breakdown, and looks like we're moving lower from here. I still think that we may come down to like 40s here, to like maybe even 39, possibly even lower. I mean, there is a glut of oil in the world, and United States producers again are ramping up production, and I think those OPEC production cuts have been quite questionable. Finally, here is natural gas. This is a daily time frame. Very volatile security. These are 52-week highs. big pullback. It's actually multi-year highs. Big pullback to almost where I thought that it will bottom. I thought it will go a little lower to like $2.50 here, but it didn't. It bottomed out here and rallied relatively hard here. You know, we could do a little bit sideways, but I think this is a bullish chart, so I think we'll eventually continue higher. So here's natural guess on the weekly time frame, and these are actually, yeah, these are multi-year highs because, well, there are 2 years here, so it's more than one. So anyways, so weekly time frame, big rally from the lows of 2016. Here I still thought that this is a bear market, but then here when we broke out above previous highs from 2016, I started treating natural gas as bullish security, and then already I was looking for entry opportunities on the long side. So again, this was very volatile and very deep pullback here from 52-week highs, and then finally we found support and rallied. So where we go from here, I think we'll probably do a little bit of consolidation and then continue higher. I mean, it's possible we'll pull back, but I don't think we're going to break $2.50 anytime soon. I still think we'll continue higher from here. Right, if you like what you're hearing, please do like this video. If you have any comments, please do comment below. And of course, share this video with your friends and whoever may benefit from this video. Again, thanks for watching and have another great trading week. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.